Let me explain oil and gas investments for those of you that are in higher tax brackets. There is a government internal revenue code that allows for something called intangible drilling costs. And what this means is when you enter into a partnership, you become a general partner into a drilling program that has costs that are intangible. And because the government wants to promote drilling, sometimes politically it may not seem so, but they offer tax incentives for oil and gas drilling inside the United States, so that those costs that are intangible are usually largely or entirely tax deductible. So for example, most programs, if you invest $100,000 into an oil and gas program, you would get an $80,000, $85,000, maybe even $90,000 tax deduction. Now think of that. If you're in a 40% tax bracket, 35% federal, 5% state tax bracket, and you invest $100,000 and you get a $90,000 tax deduction, you're saving about $33,000 in taxes. So right out of the gate, we've picked up a positive cash flow of $33,000 because it's money that we didn't pay to the IRS. So in that sense, $67,000 of our $100,000 or $67,000 is net how much we have to come up with, and then $33,000 of it is almost like it's government money that we would have otherwise sent to the government. The question then becomes, are we comfortable with becoming a general partner where we now expose our personal assets for usually for a year, and then you become a limited partner after a year in most of these programs. There's an immense amount of insurance that's purchased and reinsurance that's purchased, and every program that I've ever looked at has decades of history of never having to concern the general partner. But then we go further, we make sure that, okay, tax-wise it makes sense. I'm in a high bracket, I just sold a building, I just sold some appreciated stock, I just sold my business, and now I need a write-off to get me down below the big phase-out. I'm losing all my tax deductions because I made too much money this year. And the IRS is telling me I owe a whole bunch of money in taxes. Or I converted my IRA to a Roth because I think tax brackets are going to go up and I want tax-free income in the future. So we look at some of the things that may cause you high tax brackets and say, okay, this is one of the many ways we can proactively plan to lower your taxes. The key is, we have to feel comfortable with the investment being, number one, it's a long-term investment. This is an investment that you buy in and then 6 months later we sell. These investments generally, if we look at the last 2 decades, took at least 3, 4, 5 years for the investor to be made whole, getting all their money back, sometimes longer. And then after 3, 4, 5 years, the programs continue, the drilling continues, and sometimes 7, 10, 12, 14 years later, the wells are sold to third parties and you're finally entirely out of the program. Return on these has been remarkable. One of the best performing investments over the last several decades, largely because for the most part oil has become more expensive, and so these programs, some of them speculate and sell oil as they go. Some of them, if you're concerned about oil prices coming back down, you would want to look into one that has pre-sold maybe half, maybe 3/4 of its oil or of its gas before it even drills. The other thing about oil and gas programs you want to understand is that you can invest in developmental wells, which have seismic and geographical studies to show how much oil and how much gas is in the ground with a very, very high level of certainty. There's really not much risk that we're going to dig and find there's nothing there. If they dig 50 holes, 1 or 2 of them might not produce, but 48 of them are going to produce. So you want to be in one that produces lots of wells, so that your risk of digging a dry well goes down pretty remarkably. And then there's exploratory, and that's one that I haven't become comfortable with because it's such a high risk. There are those that are comfortable with that, but we call it wildcatting in the industry. And wildcatting means we're going to go out and take a ton of risk, and the land was very cheap, and we haven't done the seismic studies on it and so forth, but we're going to hope that there's some oil there, and we think that there's a reason that there should be. And the return there is much higher, but there's also a pretty good chance, at least possible, that we could lose all our money in something like that. Certainly the other one, no guarantees, but we do know that, okay, we've pre-sold X amount of oil, We know that the wells in the area in this shale, Marcellus Shale, for example, is a popular place, has produced X amount, and the company has this kind of track record. And as we look at those things, we realize, okay, we like the energy sector, depending on where oil and gas is at any given time, and we're in a high tax bracket, and we're okay with a long-term hold. Then this becomes an investment for most investors that are comfortable with each of those factors to have as a piece of their portfolio. Not 20, 30% of their portfolio, but certainly 5, maybe 10% of the portfolio as a great diversifier, as a great tax play, and potentially as a great upside potential with where we see oil and energy prices over the long term.